Okay, let's get started. Welcome everyone to the Federal Reserve Education Teaching Economics in Changing Times Inputs into Monetary Policy webinar. Today's webinar focuses on inputs into monetary policy decisions, and we're going to learn about current economic conditions and how they influence the monetary policy decisions, the monetary policy decision-making process. So we're going to hear from some experts who are going to, those experts who work behind the scenes to ensure that the Federal Reserve System achieves its dual mandate for monetary policy. So let me introduce myself. I'm Andrew Hill. I'm the Economic Education Officer here at the Federal Reserve Bank of Philadelphia. And I want to just welcome you on behalf of all of my colleagues throughout the Federal Reserve System. Federal Reserve Education is a group of economic educators. We're located at Federal Reserve locations, both banks and branches throughout the country, and we work to advance better understanding of what the Federal Reserve does, economics, personal finance. We work to train teachers and provide them with curriculum materials, and many of my colleagues also work directly with teachers. Today's session is going to feature a presentation followed by a moderated panel discussion with an open forum for your questions. So when you're submitting your questions today, make sure you put them in the Q&A function and not in the chat. So use the Q&A for your questions, and you'll find that at the bottom of your screen, and not the chat function. So I know sometimes in your sessions you've used chat in the past. We're using Q&A tonight. Before we begin tonight, I want to give the standard disclaimer, which is that the views that are expressed in this program do not reflect the official positions of the Federal Reserve System. So that applies to all of our speakers tonight. So let me go ahead and I'll introduce our first speaker tonight. Karthik Atherea is the Executive Vice President and Director of Research at the Federal Reserve Bank of Richmond. His research interests are in macroeconomics and consumer finance, and he earned a PhD in economics in 2000 from the University of Iowa. So Karthik, I'm going to turn it over to you for your presentation.
Very good. Thanks very much, Andrew, and it's great to be here. Hopefully all of you can hear me, and good afternoon. I just want to echo again Andrew's point about the importance that we place in the Fed at communicating what we are doing and why. It's a central part, I think, ultimately of whatever success this institution has, to have the broad world understand what we're trying to do and how we're trying to do it. And my remarks today are going to fit a little bit into both of those. I'm going to tell you a little bit about the economy as I see it right now, in case hopefully that's useful. But then I want to actually get to the theme of inputs to the policy process. And I want to give you a perspective from my vantage as somebody who attends the FOMC meetings with great regularity. So I feel like now I can tell you a little bit about how those meetings work, which I think will help you set in your mind how exactly we go about absorbing information about the world and then turning it into policy related actions. So hopefully that suits everybody well. And I'm going to share my screen with you really quickly here. And give me 1 second. Hopefully you can see that screen. And so what I'm going to do is really quickly, let's have a quick look at the current economic picture as it is. And it's got a bunch of components to it. Right now, inflation is elevated. Everybody, I think, knows that. That's a problem, obviously. In a perfect world, people are not paying much attention to inflation simply because we have it under control and in a good place at 2%, which is our target. Right now, it is not in that spot. It's closer to 6% by some measures, and by the consumer price index measures, recent month-over-month numbers have come in at about 8%. So this is among the most interesting times to be talking about inflation, at all in a long time. You can look at the measures of inflation expectations. We care about that because what people expect for inflation governs, think about yourselves. I think about myself. What I think is going to happen in inflation matters for whether I'm happy with a raise or not happy with not a raise. And all of these things must go double for everybody else. It's also the case that employers think about it when they set compensation. These are all important things, and they're all tied to expectations. And here you can see expectations depending on which measure you look at, also being a little bit north of where our ideal measures would have them be, closer to 2%. We see the consumers survey at the University of Michigan coming in at closer to 5%. That typically runs higher than what is actually ends up happening in the data, but it's still high enough that you want to think about it carefully. Better news comes from looking at the marketplace and the way it prices bonds. And here you can see that the 5-year forward, this is the yield that people expect on a this is the inflation rate that people expect to happen 5 years from now to 10 years from now. And that's closer to our target of 2%. The Cleveland Fed tracks an inflation expectations measure. That's closer to 2.5%. Wages, as I just mentioned, have been showing that people actually are thinking about needing to get compensated for the inflation that we're experiencing. You can see here that the Atlanta Fed wage tracker gives us at about a 7% wage growth rate. And typically, and perhaps not surprisingly, job switchers experience bigger wage increases than non-job switchers. And here you can see something close to 8%. So, these are features of an environment in which inflation is elevated. And this has not obviously escaped the FOMC. When you listen to them speak, they're extremely clear about their priorities right now, and really in dealing with inflation is top of mind. One picture that I'm going to, if you can see this picture here, this is really about the way labor market conditions look right now. And you can see that in many ways, the economy on the real side is doing exceptionally well. It's the unemployment rate is 3.5%. This is something that is as low as it generally ever gets. The labor force participation rate, while it's lower than it used to be, it's still on track with a trend that many of us may regard as plausible. So that's another picture of a piece of evidence for the health of the overall economy. Unemployment claims are in a good place. They're not showing anything alarming. And the payroll numbers, each month we can count the number of new additional jobs on net that get added. That's been good too. So in many ways, the economy is functioning very, very strongly right now. But the issue is, of course, inflation is not where it ought to be. All right. So that's kind of the big picture. Let me set the table for another minute or so with respect to what's happened during the pandemic. Obviously, the pandemic, I'll just talk at you for a second. The pandemic has been a period in which we experienced a stunning shift in the ability to consume and produce, certainly in the early to mid parts of 2020. It's not at all surprising that in that window of time, a bunch of prices moved. The prices of goods and services moved. It was very difficult for people to get to work. It was very difficult for us to do any of the kind of consumption that I typically think of as communal consumption, going to a restaurant together, going to the movies, going to a sporting event. All of those things that we enjoy with other human beings became very hard to execute. It became very hard to get people to come and work at those places on top of that. So, we had big shifts in the ability of people to actually work. And in the wake of that, it made a lot of sense to have an extremely robust kind of policy to deal with the pandemic, because people were hurting really badly. All right. So I want to just show you one picture here. This is really about where the Fed funds rate ended up being during this period. So the Fed funds rate, for everybody who's not paying too much attention, is the interest rate that we can think about as that the Fed really controls most tightly, and it has to do with overnight lending rates. Well, that rate of interest is ultimately something that, through people's expectations, governs how interest rates in longer maturity loans ends up being set. And so it affects things like the mortgage that we all take, or the car loans that we end up taking, and so on. And what I just want to draw your attention to is that the blue line, starting at the beginning of the pandemic, we really actually delivered a very low real rate of interest at a time when you might think that if conditions were normal, we'd want to stay a little closer to that red line. And in the Q&A, I can come back to that. I don't want to derail us right now by talking too much about it. Now, one thing that I want to point out is the question of, well, how do we get here? I've talked about inflation being high. It's been higher for longer than we wanted it to be. How did we get here? Are we chasing it? Inflation now from a place that we are unhappy about being in? I think the answer is yes. I mean, I don't think it's in a perfect, it's in a perfect place. I don't think any of the FOMC members have argued that it is. But at the same time, I think it's very difficult to kind of cast our minds back, and we should cast our minds back to the window back in 2020 when things became really, really stark in front of us. Unemployment hit 15%, and the shock itself was of an unknown variety with unknown consequences. We didn't know how long it was going to last. We didn't understand the nature of the impact it was going to have on supply chains. And as I said earlier, in the beginning parts of the pandemic, it was absolutely the case that people faced very difficult times in their ability to actually work. And those are situations in which credit becomes unusually important to people simply to get through. And so between us and the fiscal authority, we actually provided a tremendous amount of support to make sure that the economy was not hurting, or individuals in the economy, I should say, were not hurting at a time when they were terribly constrained in their ability to make adjustments on their own. Now, I think, this cartoon, if you can see it well, is kind of useful. This summarizes my view anyway. Early on, when the unemployment rate hit 15%, inflation was completely quiet and low at around 2%. And, this is the Fed. If it had been really maniacal about dealing with inflation, that's the picture you would have drawn. You had this tremendous crisis on the real side of the economy happening at the same time that you had non-existent inflation at the time. So it's not that easy to argue that boy, the Fed should have really gotten going early. One thing in the Q&A that I'm happy to try to drop a link into is analysis that's been done at the Richmond Fed recently, suggesting that even though our initial accommodation was very significant, markets understood fairly early on, even in early 2021, mid 2021, that policy would end up being normalized, and many measures of bond market yields actually are consistent with that. So there's a sense in which the Fed actually was already communicating a credible form of normalization of monetary policy back to kind of typical conditions. It's just that I think in the end, the shocks that have hit us have been very, very substantial and have lasted very long. And this is not something that I feel that I certainly am not going to claim that I understood the duration of in real time. Okay, so that's kind of where we are right now. The last picture I want to show you is just apropos of what I was telling you about policy normalization. This is a picture that some of you probably have seen at some point, and it fix your eyes on the dots on the right hand side of the picture, and there you can see what's going on is each one of those blue dots represents one of the FOMC members telling you what they think the appropriate interest rate is at the end of each of those successive years. And this is as of September. So you can see that at the end of 2022, most people are clustered somewhere between 4 and 4.5. For end of 23, you can see people clustered closer to 4.5 to 4.75 or so. And then you see a gradual movement of that cloud of dots back to something lower. And then, of course, in this longer run period at the extreme right end of that picture, you can see that the Fed thinks that appropriate interest rates will be really in the 2.5% range. Okay, so there's this feature right now where policy is likely to be set at a much tighter rate than it has been in the past, and also than it will be in the future as things normalize. So that's just giving you a sense of where policy is, and I hope that's clear to everybody. All right, so let me now quickly give you a quick sense of the way the policy process works. I think this is something that many of you may know something about, but I wanted to give you a little bit of extra color commentary if I could. At a big picture, I would like everybody in this room to know the extent to which that meeting and the policy process that precedes it is open to data and views from the economy's participants, in addition to kind of hard data that of the kind that maybe I showed you earlier today. It's not just numbers that we care about. It's the sense that business participants have about where things are headed. It's the sense of where consumers have of where things are headed, of where civic groups think things are headed, and how they're landing on how the economy is landing on them. This openness to data that that I think exists through many channels, including the Beige Book, which many of you have heard about, is, I think, truly extraordinary, and it keeps us grounded at all times, and keeps me personally from ever getting too locked in on a particular view of the economy simply because some hard data actually tell me that X or Y or Z is happening. The other thing I'll say is that we need to have this kind of openness because the stuff that comes in from the world around us is often fresher and more reliable directionally than much of the data that we look at, which will often come with a lag and is also prone to being revised. So we absolutely need to pay attention to what is happening in real time, especially also because turning points in the economy are particularly hard to predict. The word business cycle, or the phrase business cycle, is a tiny bit of a misnomer. There isn't a cycle in the sense that if you know what's happening now, you'll know what's happening 6 months from now. It's more like a story of an economy that's bubbling along, but is occasionally buffeted by very sharp shocks that we associate with recessions. And kind of predicting those shocks or understanding when they've happened is really about inputs to the policy process being tuned correctly. Are we listening to the right people at the right times? And are we hearing them as we need to hear them? Okay, so that's really, I've really wanted to emphasize the openness to what is actually happening in the world. The culture of the process and the meeting, especially, it really discourages dogmatism. So one point that I hope, you have to believe me, I suppose, but or you don't, is I want to convey to you how open-minded people are and how it's frowned upon to come into an FOMC meeting from the viewpoint of the policymakers to just be locked in and say, yeah, I know what's going on. I know exactly how everything works. And here's what we should do. Nobody really talks like that in meetings. And if they do, it's not a great way to have any traction. You want to act like a magnet. And what I mean by that is that you don't want to be so far away that you have no gravitational pull or no magnetic pull on where the direction of the conversation is going. But you don't necessarily want to be right next to the next person because that doesn't allow you to move the direction of the conversation in ways that are truthful or truth-seeking. One interesting little protocol bit that hit me a long time ago was in the meetings, the FOMC Secretariat seems to have quite a bit of latitude in terms of deciding who goes first, second, third, and fourth, and so on in the go-round where people talk about their views. I think that's the kind of thing that exactly prevents people from coming in and saying, well, I'm going to talk at the end, and then I'm just going to say, yeah, whatever X and Y and Z said already, don't worry about it. And I think it encourages a lot of preparation. The downside, if there is one, is that one has to listen to many, many statements that often do overlap quite a bit because these are reasonable human beings looking at the data and thinking about policy, in real time. So, that's sort of the trade-off. Very quickly, the policy process really gets rolling in earnest at T-minus 2 weeks, I would say. So if the meeting is in 2 weeks from now, right now is when we'd really start rolling. We get these incredibly rich analyses that are prepared by the Board of Governors staff in Washington at the Fed there, and that's I think a remarkable piece of work. It's done on a regular cadence by really dedicated and highly professional staff. That's sent to Reserve Bank research departments. That's a huge effort to characterize the current state and likely path of the economy, and that's actually where a lot of attention is given to looking around corners, including things like having a section dedicated to risks and uncertainty, and then thinking a lot about what ifs. And there we talk about what would happen if X or Y, Z happened in the economy, and we reacted with policy in the following way. So this is a key input to the policy process for all of us at reserve banks. I'm talking to you from one of the reserve banks. There are 11 others, and we work together to process this and then also give our own take of what we think is happening, and also give our own reactions to the analyses provided by the board staff to our president. That's the principle that people like me serve at my reserve bank, and then the same thing happens at the other 11 reserve banks. Now, I've already talked about the first bullet point there. That's really about us putting in our input and adding our analyses to what is happening. We're of course operating at the reserve bank level at a much smaller scale. We have about 24 economists in Richmond, and that's a common type of size of reserve bank research departments. The board has a vastly larger number, and that allows them to specialize in various parts of the economy that then allows them to produce the documents that I mentioned a minute ago. The next thing that happens is that we receive draft proposals for what the policy statement that all of us read about, the FOMC statement, actually looks like. And so, if you're interested, you can always go back to the transcripts of the meetings, and they're released with a 5-year lag. They're all available. And I hope that, at least one or two of you will say, okay, let me take a look at that, because the whole meeting is in there. And you'll see that the statements come in flavors. They're either dovish, one that's meant to reflect the consensus, think of that as alternative B, and then one that's more hawkish in terms of what the policy stance ought to look like. And what we do, again, this is kind of reflective of how collaborative this process is that statement, that set of statements is sent out to us a little earlier, and then we weigh in and give comments on what we think the wording ought to be, and what we think the options ought to be, and so on. There's some iteration, and then we end up with a statement that we then vote on, that the policymakers rather than vote on. Okay, so let me give you this is the new building, in which this is actually what it looks like. So this is an in-person meeting of the principals. So people like me, now I think starting next meeting back again, we're going to be also in that room, and we'll be in the chairs right behind them. And again, a piece of culture is that this meeting is people prepare very hard. And so if you hear me talking in that meeting, I think it's fair to say that things have gone not exactly according to plan, because we've been intending to deliver a statement that is very carefully crafted. All right, and at the meeting, there are 2 go-rounds. I won't belabor this too much. There's an economy go-round where everybody talks about the economy, and I've kind of talked about the soft data that we bring to bear, and the culture to avoid really telegraphing too much about your policy views at this meeting. You're really trying to describe how you see the economy through the lens of each district. And then the next day you have a policy go-round where we think about where we vote, where we describe what we think of as the right thing to do, and then that's followed by the chair's press conference. So hopefully this gives you a sense of the way that the policy process works. And I think I want to pause here and give it over to Andrew and for some Q&A. So thanks.
Thanks, Karthik. We have a couple of questions here. So here's one that I think is really a great one to think about. How's the Fed prioritizing the information that it's receiving? And what is the FOMC relying upon to make informed decisions within the spirit of openness?
Sure. So with respect to prioritization, I mean, the mandate helps us focus on the 2 things, inflation and the labor market. Those are very central. So there, we want to know everything that we can possibly know about what's happening in the hard data. The inflation numbers tend to be measured fairly real time and fairly well. So we're able to pick up a lot of that information through hard data sources that the BLS, the BEA, and other organizations provide us. The national income accounting process in the US is stunningly good. And so we're able to construct a lot of measures of prices, or avail of them, I should say. Labor markets are produced with the BLS, the Bureau of Labor Statistics, is also extraordinary in giving us a lot of good labor market data. So those are the 2 highest priority things right away. But then the Beige Book, which is another source of data that comes from our contacts in the district, proves very important. In that economy go-around that I mentioned in the previous slide a couple of minutes ago, that's really where people are talking about their districts. Well, what do they know about their districts? A lot of what they know comes from their contacts. It also comes from the outreach operations that almost every Fed engages in to talk to the community at large across its various facets to understand what is actually happening. Does it pass a smell test that the economy is performing well right now? Does it not? So it's that mixture of hard and soft information that's focused on inflation and unemployment, but then feeding into it other things like manufacturing output, industrial production, service sector surveys that we conduct, and so on. So that's that. And then the second question I think had to do with how we balance the inputs. If I remember correctly, Andrew, go ahead.
Yeah, and how do we think about making sure that we have this level of openness? What's the spirit of openness with the FOMC?
Yes. So you should ask other people this question as well. My personal take on it is everybody feels a sense of responsibility to get to the best possible decision. When I first personally went into the FOMC meetings starting 5 years ago, it happened in a very big room. And sometimes rooms are important. This is my personal experience. When you go to a magnificent church or some other building, the building is important because it kind of reminds you of who you are and who you're not. And I think one of the things that I think does for everybody is to say, try to make a good decision. Don't try to make this about you. Don't try to hot dog. Don't try to be a loudmouth. All of those things are things, behaviors that I see consistently adhered to. And the chairs, I think, are really important in always making sure that the process ends up being very, very collegial. There's a protocol for asking questions. And all of that feeds into this idea that you need to behave well if you want to be heard.
So another question, what current economic conditions concern you the most at this point?
I think unambiguously inflation. At a time when the labor market is doing what it's doing, in some sense, the monetary policy problem is both vexing and simple. It's vexing in that we're far away from target right now. It's simple in that, given the other mandate, there's nothing anybody could tell me to say the labor market is not functioning at a high level right now. So that leaves only one problem in front of us.
So that brings a question that came through as well in the Q&A, and this is sort of the classic question of the tension between these two goals of the dual mandate, the low unemployment and the low inflation, keeping price stability. How do you think that dimension and those concerns about how we try to achieve both of those goals, both of those parts of the mandate at the same time? How do you think and how do you see that those things come into play in the FOMC meetings?
Yeah, so despite what I said about inflation right now being problem number one, it is absolutely the case that every FOMC participant will describe the state of the labor market. And in the policy discussion, invariably, there will be a question of how is it that we can achieve the inflation goal with the minimal consequences on the labor market side. That just because we're at mandate there doesn't mean we've forgotten about it, and far from it. I would say, if you look at the utterances of the chair and the FOMC members in recent speeches, they are thinking heavily about how is it that we can communicate our intentions to avoid the least level of uncertainty and surprise to the labor market that might cause firms, businesses, and households not to exactly understand where we're headed. That's done with a view ultimately to minimize real economic hardship that comes with job-related dislocation. So it's never, ever far away from top of mind. And I think there's no one on the committee that has made public utterances, of the form, just full speed ahead. We don't care what's going to happen with unemployment. That's never a conversation that I've heard. So I hope that helps answer, how the labor market really never leaves the center stage, honestly.
Right. One of the questions that comes up from time to time, and it's been brought up here in the Q&A tonight as well, is how and if there's any consideration of the differences in the sizes of the various Reserve Bank districts in the considerations of the FOMC. When they're formulating policy, are there any considerations of the differences between these Reserve Bank districts?
So that's a great question. So monetary policy is set with a view for what's good for the United States economy. The regional reserve banks are regional for a variety of reasons, importantly having to do with understanding what is actually happening on the ground in any particular district, and also, of course, thinking carefully about the nature of supervisory work on the bank regulatory side. The broader history of the Fed reflects this need to have a federated system in which it is not so centralized. There's a deeper history here that goes back to the Americans in general not being too excited about a highly centralized central bank, one that is Washington only, one that is government only. So instead, you get this hybrid system that is not government only, but is government plus nonprofit corporations, plus regionally distributed. But when it comes to monetary policy, everybody's thinking about what's good for the economy as a whole and views their policy recommendation through that lens. However, one of the nice things about the way it's done is that we may hear in a given meeting, for instance, the policymakers all mentioning certain things as having come up and being salient in all of their districts or in a majority or a plurality of the districts. Then it becomes much harder for us to say, well, we should walk away from that. Now we've heard it from 5, 7, 8 districts that X, Y, or Z is happening. Bank loans are not being paid back the same way they were. People are reporting difficulty finding work. So that regional perspective is always critical to understand, what is happening on the ground level. But then in the end, everybody puts on a U.S. economy hat to make a policy decision. That's certainly my view of how that goes.
Thinking a little bit about our target audience tonight, and as you know, these are K-12 teachers, and not everyone is teaching necessarily an AP macro type
Right.
course. Thinking about that, what do you think are some of the key takeaways or key points that we should be conveying to our students in high school, middle school, about the current economic conditions? What do you think sort of the key takeaways are, particularly if it's just sort of a general econ class, or if you're teaching a social studies class with some economics that's infused into it?
Yeah, that's a excellent question. I mean, I'm going to give you an answer that will sound a little bit self-serving. You don't know me well enough to trust me, I suppose, but I will try anyway. The way I've framed the last, several years has been a country that was hit by something essentially catastrophic. It has since proven to be catastrophic in that about 1 million people have died, and that doesn't qualify. Nothing does. It happened, and it set in motion economic constraints on a population that really were unprecedented in terms of stopping people from being able to work, and then making it difficult for people to access credit and so on if their conditions had deteriorated. So faced with that, I actually think that the coordination between the broader parts of the government and the Federal Reserve, have been essential in cushioning initially the blow that was happening. And I think a lot of that came certainly from fiscal policy, but then subsequent to that, a lot of the support for the credit market, for liquidity support in general, came from the Fed. And we really did act, I think, fairly effectively to keep the bottom from falling out. It's turned out that the constraints that we faced were more durable than I think we anticipated. I think there's no question about that. And so now, we're trying to undo that with minimal damage to the real economy. But I do think, in the main, if the takeaway from this is the economy got hit by a pandemic of, enormous proportions. We had a couple of quarters of 15%, or one quarter 15% unemployment. But then we sort of righted the ship pretty dramatically. And then in the end, we suffered through about a year of 5% inflation before settling down to something lower. That doesn't look like such a bad policy response in total, even as we might not like the current world so much.
Yeah. So just shifting just for a minute here, as we have a couple of minutes left in this little portion of our program, and then we'll move on to our panel. As you know, and this includes your colleagues in the various research departments across the reserve banks, but also my colleagues and I are working as well on trying to increase the number of young people who are interested in pursuing degrees in economics, and hopefully then move on to getting PhDs in economics and joining us at the Fed as well.
Yes.
Eventually. Can you tell us just a little bit about your path to economics as your career, as your field, and what excited you about economics and what brought you to the field, so that we give our teachers just a little sense of that as an economist?
Yeah, I'm happy to. Really quickly, my story is fairly simple. My parents are immigrants from India. They're very, very connected to India. So I ended up spending a lot of time there. Every year I spent 4 months there. India at the time of my early childhood was extremely poor. It's still poor, but it's not anywhere near as poor. That contrast to me made it almost impossible not to think about economics, because I couldn't quite understand how it is that one society is able to deliver so much for the average person and the other one struggles so much to do the same thing. And that got me started, and I haven't really looked back ever since. But I want to get back to the first part of your question, though, Andrew. Like, as K through 12 teachers, one of the things that is true about the economics profession is that it is not particularly plural. It lacks representation from women. It lacks representation from minorities that are not, let's say, South Asian immigrants like me. There's, you might have a hard time arguing that there's any underrepresentation of people like me in the profession, but African Americans are incredibly underrepresented.
Yes.
And that kind of really tells you that something needs repair within the economics profession. And I think my colleagues in the system and I are all thinking about how we can actually make it better. One thing that I think has to be done, though, is to make sure that we connect better with K through 12 teachers to show the breadth of topics that economics actually tackles, because it will I think it necessarily will have resonance with a broad group. It cannot be that African American kids are not interested in understanding economic phenomena any less than anybody else. And in fact, I would argue they would have a much greater interest in understanding how it is that the kind of inequities that we have come to be. And so something has not happened properly in that handoff. And I think the economics profession needs to actually figure out how it can work with K through 12 instructors to get a lot more people aware that these problems are also for you to work on, and we need you or your students to really get engaged with them, especially if they're from diverse backgrounds. So that's a really critical point.
Yes. So Karthik, I want to thank you so much for joining us and sharing your take on economic conditions and on what's going on with monetary policy implementation. It's really always great to have somebody who's been in the room and is in the room consistently with the FOMC. We're going to move now into our panel as well. So again, thank you, Karthik. I want to introduce Anjali Nair. She's an outreach analyst with community engagement at the El Paso branch of the Federal Reserve Bank of Dallas. And as part of the Dallas Fed's Communications and Outreach Information Network, she leads the department's analysis of anecdotal information that's gathered from extensive regional outreach within the Dallas Fed's Federal Reserve District. And she reports then on real-time economic trends during each of the FOMC cycles. So Najala, I'm going to turn it over to you, and you can moderate then our panel for us. Thank you.
Great. Thank you, Andrew. Good evening, everyone. I'm sure similar to our audience today, I'm quite excited to hear from our panelists. So to start us off, let's go around the panel and have each of you briefly introduce yourselves and describe your role at the bank. So if we can go along the lines, if we start with Charles, Leslie, and then Elif.
Yeah, thank you for having me. I'm Charles Gaskin, a senior economist at the Federal Reserve Bank of St. Louis, based here in St. Louis, Missouri. And I manage our current economic analysis team, which tracks both district economic conditions in our Federal Reserve District, as well as national economic conditions.
So hi, good evening. I am Leslie McGranahan. I am the Vice President and Director of Regional Research at the Federal Reserve Bank of Chicago. So I manage the team that studies the regional economy in our economic research department. So we have three parts. We have researchers that do research on topics related to the regional economy. We have individuals in Chicago who do outreach and seek to understand the economy from the perspective of the participants in the economy that Karthik mentioned. And we have individuals in our branch in Detroit who do outreach and follow the auto industry and the economy in Detroit. And then I share the information gained from all of this work with the bank president so that he can better understand how the economy is doing when he's making decisions about monetary policy.
Hi, everyone. My name is Elif Sen. I am a senior economic analyst in the regional group in the research department at the Federal Reserve Bank of Philadelphia. It's quite a mouthful to get out. And I am on a team of 5 analysts, and we are predominantly tasked with assessing economic activity in our region through outreach and through conducting a number of business surveys. So we look at not only official government statistics, but we're also trying to capture economic activity, and we create data and collect information as part of our process to inform our bank president. And once a year, I am responsible for doing that regional economic conditions briefing for our bank president before he goes down to the FOMC meeting.
Great. Thank you all. As you all can probably tell, we have colleagues representing different regions on the panel here today. So we're hoping that as educators, when you leave this discussion, you leave with a more complete picture. So to maybe help us better understand what those regional differences are across districts, could each of you share what are some of the specific sectors of the economy that your bank focuses on? So if we can start with Leslie and then have Elif and then Charles, that would be great.
So yeah, so from the Federal Reserve Bank of Chicago, we really focus on manufacturing, agriculture, and autos, as all three of those have a disproportionate role in the economy of our district. Autos in particular, the major auto producers. Many of them are in the Detroit area, and a lot of the auto supplier base is within our district as well. We also focus on issues that are confronting the Midwest. So where the population is kind of growing more slowly than in the rest of the country, and where we have a number of major industrial cities, so Chicago, Detroit, Indianapolis, and Milwaukee, amongst others. So those are sort of the areas that we tend to focus on.
So unlike the Chicago district, I'd say the Philadelphia district doesn't really have one or two dominant sectors that we are making sure we're paying attention to. Historically, the Philly district, which covers the eastern 2/3 of Pennsylvania, the southern half of New Jersey, and all of Delaware, has generally been a bit of a microcosm for the broader national economy. We do focus on the manufacturing sector. I'll get into it a little bit more specifically, but we have a very long-running regional survey on manufacturing conditions. And our bank, it's not in our research department per se, but we have a consumer finance institute, and they tend to focus especially on consumer behavior, particularly as it interacts with different financial regulations, their spending, their borrowing habits.
So in St. Louis, I'll just make a slightly nuanced point, which is I think we're trying to gain information on two parts. One is information from firms about what's going on locally, but then on the other hand, we also want to talk to firms located in our district where we have good personal connections with and strong networks, and they can share information about what's going on nationally. So in our district, we have a lot of transportation firms with both UPS Airlines headquartered in Louisville, Kentucky, FedEx headquartered in Memphis, Tennessee. JB Hunt is located in Northwest Arkansas, as is Walmart. So, national firms like that can provide a great picture on what's going on nationally, as well as what's going on in our district. More locally, we have a healthcare council, as many of our metropolitan areas have large hospitals as major employers. So we always focus on healthcare, which has been incredibly important during the pandemic. As well as real estate, as national trends often capture what's going on in coastal cities and may not capture what's going on in our district. So that's a place that by focusing on local real estate, we can kind of get a better picture of what's going on in that area.
Great. Thank you all for helping us better understand some of the work that the regional banks are doing. We now have a couple of specific questions for the panelists. So if we can start again with you, Charles, that would be great. So the question that we were wondering about is what goes into the beige book? And for the educators on the call that may not know what the beige book is, if you can start by explaining what that is, that would be great. And maybe the second part to that would be, what does it look like to brief the president of the bank on the outlook for the regional economy prior to an FOMC meeting?
Absolutely. So let me start with the content and then I'll get to the report. So as we kind of already talked about, we get a lot of economic data from government sources as well as private sources to track the economy. But ultimately, we're trying to get a sense of what the outlook is and where we are today. And a lot of data is backward looking. So the way we get a sense of where the economy is today is by having conversations with businesses and community leaders throughout our Federal Reserve District. This is done through meetings of our boards of directors, both at our headquarter office and our branches, as well as running surveys and hosting roundtables. So just today, for example, we had a tourism roundtable, which we typically do right after Labor Day to understand what's going on in the tourism and hospitality sector. Ultimately, all of that information is going to feed back to our bank president for monetary policy purposes. What we also do at the same time is try to take that information and distill it down into a concise report that we can share with the public to give them a sense of what we're hearing from people throughout our community. So that's ultimately what the beige book is. All 12 reserve banks will write up about 2 pages summarizing the anecdotal information that they're receiving from contacts around their district, and then we'll release it in a report. Typically comes out about 2 weeks before the FOMC meeting, and I believe the next beige book is going to be coming out tomorrow, if I've got my dates right. I think I forgot what the other question was about briefing our bank president. So similarly, we're going to collect all this information. Some of it will be over beige book, and other information will come in a little bit later. We'll take all that information, we'll match it up with the data, And then what we do at the St. Louis Fed is we'll have a discussion on economic conditions. It's typically about a 2.5 hour long meeting with all the staff economists in the research division and our bank president and other senior leaders, where we'll have various sections. So one on US economic conditions, financial market developments, and then one piece of that will be on the 8th Federal Reserve District. Again, not only what's going on within our district, but also what we're hearing from district contacts about what's going on nationally and possibly even internationally in some cases.
Great, thank you, Charles. Leslie, we were wondering, as the Director of Regional Research, how do you lead your team in publishing relevant regional content? And I think this question is particularly interesting because I feel like in your role, you're always surrounded by really interesting information. So how do you figure out what exactly do you want to share or what's important to kind of be discussed and to know?
So in terms of research could really go into two different types of publications. There are our Chicago Fed publications, and there are external publications like journal articles and the like. All of the different Feds have their own Fed publications. So I help my team think about research ideas, and then I help them make sure that they have access to the resources that they need to do good research. So the real resources are like time, so that they have time to think and work on research, that they have data to do research, and data can come in many different forms. There's some of big data sets, but there's also like sort of specialized data, something like data on where auto firms are located that we might get separately. And then they also need access to research assistants. So research assistants are individuals who recently graduated from college and help with research. That's sort of a nice entryway into the economics profession. And all of the regional Feds have research assistants, and the Board of Governors does as well. So that's sort of after college getting exposed to the economics profession. And then I also support the researchers on my team when they want to get feedback from others who think about similar issues by either going to conferences or bringing people together internally to discuss research issues with their colleagues. In fact, Charles and I were just last week in Kansas City together at a research conference. But for the most part, the members of my team are very passionate about questions related to the research, to the regional economy, and they're really interested and they're very self-driven to do research. And a lot of my role is to both be a sounding board about, sort of the directions research can go and make sure that they have like the support they need to move that forward.
Great, thank you, Leslie. Alif, I know you briefly touched on the business outlook surveys when you were introducing yourself. So if you can tell us a little bit more about the surveys and how they might inform your bank's outlook on the economy and monetary policy in general.
Sure. And so, yeah, this touches on a lot of the points that Charles was making in terms of we reach out to contacts in our district, both business contacts and consumer contacts, to get their sense of what's going on, whether they are local firms operating locally in the district or have a larger, more national or even international footprint. And one of the ways that we do collect information from business contacts, aside from more one-on-one conversations, is by running 2 monthly business outlook surveys, one on manufacturing firms in our district and the other focusing, it's an inelegant name, but any firm that is not a manufacturing firm, a non-manufacturing business outlook survey. I'm going to focus more on our manufacturing business outlook survey for a couple of reasons. One, it is the longest running regional survey of its kind. It started in the Philadelphia Fed back in 1968. And it's focused on manufacturing firms, and manufacturing firms tend to, manufacturing sector tends to be more cyclical and gives a more direct sense potentially of what's happening in the overall economy and what we'll be seeing in the GDP numbers for the national economy. So our survey is qualitative in nature. So each month we send out a link to our list of participants and we ask them to tell us how a specific company measure, whether it's new orders or their employment levels, how it changed relative to the previous month. So we just wrapped up the October manufacturing survey. So we asked them in October, how was employment higher, lower, or the same as it was in September? And also looking ahead over the next 6 months, do you think employment will be higher, lower, or the same? And so we collect all of their responses for all the different questions, and we can aggregate these results and have more of a numerical measure to track over time. And this survey has been very valuable, partly because of its long history. We've been able to do analysis on it and see that it is fairly closely correlated with national GDP trends, national industrial production trends. And it's also a timely measure. Karthik touched on this a little bit. We're often working with data that's lagged at the national level. It's lagged even more when we're looking at state level data or metropolitan level data. So doing these surveys more in real time gives us a better sense of a current business pulse. And then the results that we get from these surveys, as well as comments that participants will share with us, are very important inputs both for our Beige Book report and for our pre-F1C briefing processes. So after you read the new Beige Book released tomorrow, I also encourage you to check out our latest manufacturing survey results on Thursday morning when we post them publicly.
Great. Thank you, Olif. So now we can move on to some of the questions from our audience members. So if you have any questions, feel free to go ahead and add them to the Q&A chat. I'm now going to go ahead and maybe pull one and perhaps combine it with a question that I have as well, which is, could each of you maybe tell us a little bit about why you got into economics in the first place? And what's exciting to you when you think about the field and your current work? So if we can start with Leslie and then have Olif and then Charles go.
So why I got into economics in the first place is I really liked the way economics approached asking questions. So, just economics can be really disciplined about how you ask the question and how you think about the answer, but much more like open to what the answer is. So I really liked the fact that you would go into something with, with this is how we ask our questions, and then you let the answers emerge from that process. That's really what appealed to me about economics from the beginning. And I think that that's really feeds in very well to the conversations that we have with the outreach conversations that we have, in that we ask really good questions, but we're really open to, and we want to hear what the answers are. So we're much more concerned about, we go in asking good questions, but we're really open about the answers. And I think that's what really attracted to me to economics in the first place.
And can I ask a quick follow-up, Leslie? Was there any question in particular that you were really curious to answer when you got into the field?
In terms of my research, I'm really interested in how fiscal policy affects households. So, when things change in terms of taxes or benefit programs, how that makes household decision-making change and how that affects the economy. So that was sort of the motivating question. And as a researcher, that's sort of the theme that runs through a lot of my research.
I have a slightly less romantic answer. I took a class in college. It was one of my first economics classes, my first exposure to the science, and I really liked it. I love math, but I really appreciated that economics was a much more tangible approach to the world. And so I thought I was going to be doing pre-med in college, and I ended up switching to economics after really enjoying my intro to microeconomics class and learning about how firms make decisions. And then Leslie mentioned RA's research assistants at the Federal Reserve District Banks, and when I graduated college, I applied for a job to be a research assistant at the Philly Fed, and I ended up there, and I am still here to this day. I've managed to carve out a higher role for myself, but just the academic, the constant quest for answers, looking at new questions, trying to understand how, just how the economy is functioning and how what we do on a day-to-day basis plays out is, what keeps me going.
So I would kind of build off of what Leslie said, and I think early on when I took microeconomics or even intro macro, I mean the questions that we looked at tended to focus very closely on the economy and how people make money and how jobs are matched up with firms. And I quickly realized that there was something else going on in the background in economics, which is that we're really learning these tools on how to model. And that's something that Leslie kind of talked about. And that these tools can be applied to a wide variety of questions beyond just topics of money and banking and business and finance. And how people negotiate contracts, how they trade with one another, how you make different choices. And ultimately that was the piece that got to me, which was that this is it's a toolbox basically that you can use and apply it to a wide variety of questions once you kind of start to understand it. The other part that I found to be incredibly powerful about economics was that it forced you to write down your assumptions. And it's easy to get facts and assumptions muddled together in a lot of different frameworks. And in economics, we really have to sit down and write down our assumptions and then start questioning those assumptions and testing those assumptions. And that was the piece that I ultimately found to be really useful. It was like a toolbox that forced you to really start to think hard about what your prior beliefs are, how are they shaping your view of the world, and how do you ultimately write this all down and how the world operates. So.
Great, thank you all. I think our educators will definitely be a little more inspired with some of the answers that we have today. One of the other questions that came in through the chat is someone was curious to know what is the relationship between the data that you see in the beige book, so maybe some of that more real-time information, and some of the more condensed economic data that maybe is more representative overall. How do you kind of look at that relationship? And I think they also went in to say, does one lead the other, and how do you kind of use them together? So if any of you want to kind of hop on and answer, that would be great.
Yeah, I'll kind of kick this off with a good example. So we'll go back about 5 years. In talking to contacts, some of the contacts that I talk to on a regular basis are staffing firms and payroll firms. And they provide us, and always have provided us, with a high level overview of what's happening within the labor markets for the clients that they serve. So they can kind of give us early snapshots about wage growth, estimates on how healthcare premiums are going to be increasing, things like that. Some of that data now is publicly available, and companies provide it, like OpenTable, for example. You can go on there and get tracking numbers of people that are making dinner reservations. That used to not always be widely available, and that was the kind of information we were collecting, firsthand from our business contacts. So it's not always the case that it's leading. It's just that we can sometimes get it more timely. But then there are other places. For example, when I was talking to our tourism council today, they're booking business out, 3 months, 6 months, 12 months in advance. So they also have a sense of kind of where things are leading in their sectors of the economy, if they have an order backlog, if it's manufacturers, and that kind of information can ultimately give you some heads up as to where the economy might be going. You can take that to the models and look at what our model forecast might look like and think about what the risks may be. And are the anecdotes coming in softer than what the model might be telling us? Or do they suggest that maybe the economy is improving faster than what the model might be telling us?
I would just add to that. I think that one of the things that the anecdotes are really helpful with is giving us some of the why behind the hard data. So, I think another example on the labor force side is, we saw labor force participation fall off pretty dramatically during the pandemic, and, labor force participation, it hasn't really gone back to where it was. And we can see in the data who this is, but by having access to the staffing firms or individuals in the economy, we can say, why is it people aren't going back to work? What are you hearing? And it sort of gives kind of flesh to the bone of the data, that it kind of gives us a more comprehensive picture, especially when there are things that kind of make us question kind of the why and why we're seeing what it is that we're seeing in the data. So that's another feature.
Yeah, I would echo that. And some of the data that we collect gives us a different angle at what we're trying to measure. You know, our Outlook surveys aren't giving us quantities of how much employment has changed or how much activity has increased necessarily. We're more measuring the breadth of activity increasing among our survey firms or not. And so we can kind of use those in tandem with the more official statistics to maybe set up models to sort of have a benchmark of, okay, if our survey data is at this value, maybe that's going to translate into this increase or decrease in the official statistics, or it's more a way for us to kind of pick up on turning points or other things that might be going on.
Great, thank you. Another question we received, Charles, we received it because you had mentioned the tourism roundtable. And I think they're curious to know how do banks decide which surveys or roundtables to host? And also a follow-up to that, do all banks host a tourism roundtable?
So I would say at our bank, we have 4 standing councils that meet twice a year: agribusiness, real estate, healthcare, and transportation. So those ones are standing. And then we typically have about 1 a quarter small group roundtables. So I'll run those ones. The other standing ones our bank president typically attends. And they'll rotate. So, I mean, tourism is a pretty standard one that we've always done. Sometimes we'll have staffing firms. I know there was a period in time when we're having a lot of trade disputes. So we corralled a group of leaders together that are really active in international trade. And then we had a roundtable on that. So they will change depending on what's going on in the economy and what's important. It's really about kind of building these relationships so that we have trusted partners to work with. It's not always the case that meeting, you know, today is going to give us something really useful, but we need to know who we can call and ask questions when we want to understand things. Particularly in healthcare, I think it's a great example. I mean, the sector is incredibly complicated, and if it wasn't for our healthcare contacts, you know, we lost a lot of times in really truly understanding how pricing mechanisms are operating, how the sectors are faring. So they really educate us a lot on the inner workings of many of these sectors, getting to Leslie's comment about getting to the why.
And then just,
sorry,
Anjali, just generally, you know, every Fed kind of has the same general goal of collecting information and curating contacts to help provide valuable information. Every Fed has a different approach to collecting this information. So no, not every Fed necessarily does roundtables or might do some variation of that. And I think that is also dependent on the geographic footprint of the Fed too. The size of the Fed district can impact how the outreach is conducted, and you know, if it's split among different branches or different groups, or if it's more located at a single location.
Great, thank you. And the last audience question we're going to be taking, they were curious to know, how do we make sure that there are diverse views represented in the context that we talk to? So this could be the surveys, roundtables, it could be any kind of research that we're doing. How do we make sure that we're getting an accurate sample across? So if each of you could go and quickly run us through. So if we can start with Leslie and then go to Charles and Alif.
So I think that's like a really, really great question. And that's a question that we've really been wrestling with because, you know, to some degree, the people who talk to us is something of a coalition of the willing. And so how do we make sure that we're hearing from broad representation in the economy? I think, you know, we start out, we make sure we hear broad representation geographically. So we have roundtables within all 5 of our district states. But also we've partnered recently much more extensively with our community and economic development area to make sure that we are also hearing the perspectives of their contacts through like community groups and other organizations that primarily serve low and moderate income communities, to make sure we're also bringing that voice to the table. But it's an ongoing work in progress and something we're really thinking hard about and, you know, hoping to continue to expand and do better in.
So I guess I would make 2 points. So one, I think it's important in training our contacts, and that we're not necessarily looking for their own personal views, but we want them to represent their organization, be that a hospital, a community college, a large company, or a small company, so that as employees turn over at these firms, we're getting consistent representation. So I think that's the first point I would make. And then we're fortunate that we have 3 branch offices, and we work very closely with our directors at those branch offices. And they do a lot of outreach on behalf of our bank in St. Louis, and working with them to get to the right contacts and the right groups, so that we can, and they ultimately give us in our case a written report of what they're hearing, and we want to make sure that they're getting to those right groups. It's amazing. What I found really amazing is just how much information different community leaders have. They're not just a CEO of a company, but they may be a member of 2 or 3 different boards in their community, and they can bring all that stuff to the table. So.
Yeah, I don't necessarily have anything too different to say than what Leslie and Charles have already put out there. It is, something that we are constantly focusing on and working to improve, making sure we incorporate additional viewpoints, at least internally, because of the academic culture. There's, we have meetings, we discuss viewpoints. We want to hear from everyone. We rotate who does the briefing for our bank president, so that he's getting a variety of viewpoints throughout the year. And then at the FOMC broadly, you have the roundtable to make sure that what's going on in different districts get filtered in. I'm sure that's not exactly what the question was going for, but even as we continue to work towards including more diverse voices in the information that we're collecting, we still have a culture of including unique perspectives.
Thank you. That was actually really helpful. And Olivia, to your point, I think it's interesting to kind of think about that it's not just diverse voices in what we collect, but who is doing that information gathering, right? So the fact that we have diversity behind the scenes, or we're working towards that's quite inspiring, and maybe even takes the conversation to a new direction. But perhaps in the last few seconds we have here, I can quickly have us go through and maybe think of 2 or 3 points that you think educators should be taking back from this discussion to their classrooms. What is important for students to know from this when it comes to understanding the monetary policy process? So if I can have Charles go first, Alif, and then Leslie.
I think the first point to make is that the FOMC is a committee. It's not just one person. I know that the chair gets a lot of attention and speaks on behalf of the committee. But there are essentially 20 people around the table, or more or less, having this discussion, sharing very different views at times, and reaching ultimately many times a consensus that everybody's voting to agree to. There are dissents at times, and people will disagree. But broadly speaking, I mean, they're working in a collaborative nature as a group. So I think that's the first point I would make. And then, we talk a lot about how monetary policy impacts the economy with a lag. What that means is that we have to forecast the future, oftentimes not knowing where we stand today. And so that's where a lot of this information gathering becomes so important, is we need a forecast oftentimes today before we can forecast the future, and then think about how policy is going to impact that path for the future for the economy. And that becomes incredibly challenging to hit the nail on the head, so to speak.
As has come up a couple of times during this panel and even during Karthik's presentation, we're looking at a lot of qualitative information in addition to the harder numbers, the official statistics. So it's not just 1 or 2 single numbers that we're paying attention to. There's a lot of effort going into collecting additional information. And that's another point. This is monetary policy is a vastly collaborative effort. We have the FOMC committee who ultimately sets monetary policy, but there are a number of people at individual reserve banks working on outreach, working on products, working on creating data to help inform that process. And just to echo a point that Karthik made, you can read transcripts of the FOMC meetings if you want to get a more in-depth sense of what gets discussed at these meetings and how laborious the entire process is. It is on a 5-year lag, but it would still give you a general sense of how the current meetings are operating.
And then just two things I wanted to say. One is just to reiterate something that Karthik mentioned, is that even though we're 12 different reserve banks, there's one national monetary policy. And what we're really doing is we're thinking about how to get the best picture of the national economy. And I think, that's sort of the genius of the Federal Reserve System, is that we're looking at the same thing from many different angles. And by looking from those different angles, we're getting a much clearer picture of what's going on nationally. So that we're really all thinking about the national economy, but bringing our unique perspectives to that discussion. And the second thing I would say is just that, we're a really mission-driven organization. That that the Fed, our dual mandate goals and serving the public are really what motivates all of us every day. And that's a really important part of how we think of ourselves and what we're trying to do.
Thank you all. With that, we have reached the end of our panel, unfortunately, but thank you to all of the panelists for helping us better understand the inputs to monetary policy. And with that, I can turn it over to Andrew.
Thank you so much, Anjali. Anjali, first of all, thank you so much for moderating the panel, and Alif and Charles and Leslie, thank you so much for being on the panel and sharing your great insights with our educators. And also I want to thank Karthik for his great presentation as well. We want to just share a couple of things with you that are coming up, Federal Reserve programs that are coming up. So the Board of Governors is hosting a great program on careers in economics. That's on October 20th. This is for both teachers and for students as well. So it's something you could incorporate into your classes as well. And so they'll be exploring career opportunities and diversity in economics and thinking about what are the career pathways that we have within the Federal Reserve System. It's not always just about becoming an economist or working in the research department. We have a number of other career pathways that connect with economics as well. Our wonderful colleagues at the Federal Reserve Bank of St. Louis have their professors conference. So if you are a faculty member at a college or university, this is for you. It's November 3rd, November 4th. It could be either virtual or in person at the St. Louis Reserve Bank. The registration deadline's coming up though. It's October 28th. So their fantastic professors conference is coming up, and I encourage you to check that out as well. And then we have the Women in Economics Symposia that are coming up. So there's in Cleveland and in Cincinnati. This is in virtual or in person on November 7th with our colleagues at the Federal Reserve Bank of Cleveland. That's coming up. And then on the 23rd of February, our colleagues at the St. Louis Fed are doing that as well. So this is a great program focusing on women and their role in the field of economics and their work in our field. So definitely a program not to be missed as well. So let's go to the next slide if we can, and I'll just remind everybody about federalreserveeducation.org. This is our great portal site that brings together all of the materials that are produced by my fantastic colleagues across the Federal Reserve System. So if you're looking for events, if you're looking for the recordings of this event as well, when that becomes available, you're looking for teaching materials for use with K-12 students, definitely check out federalreserveeducation.org. That should be your one-stop shop, your first stop, excuse me, when you're looking to find some materials to use in your classroom for teaching about the Fed. So if we could go to the last slide, I'll just review a few things. One is there's an event survey. You will get an email from us about this, but you can also just right away, if you want, while everything's fresh in your mind, you can use the QR code there with your phone in order to access the event survey. But you will be getting a post-event email later this week, which will include your certificate of participation, as well as information about the various resources that we've discussed in the program. And I just want to thank everybody for participating for this discussion into the inputs into the monetary policy decision making. I know I learned a few things, and I know that all of you did as well. And so we really wish everybody a great night and a great rest of your semester and your academic year. But we hope to see you at another program that we offer sometime very soon, whether it be virtual or in person. So thank you so much. Have a great night.